Many investors start panicking when they hear the term the bear market. However, these severe market downturns are inevitable and frequently only last a short while, especially when contrasted to the length of bull markets, during which the market appreciates in value. Even in bear markets, there are lucrative investing possibilities. How long do bear markets last, and what causes them? How should one invest in a bear market? Hello and welcome to today's video, which Spacecoin project sponsors. Make sure to stay tuned for more about our sponsor. What's a bear market? The word bear market refers to a fall below the market correction level. This happens when prices fall by between 10 and 19% overall. When prices decline more than this during a market correction, we then enter a bear market. That is indicated by a decline of at least 20%. Since 1974, there have only been 4 bear markets compared to 22 market corrections. The ideal time to start planning for a market reversal is before it starts. You shouldn't wait for announcements that the market is gloomy. Many investors generally become averse to trading during a bad market, and many ultimately withdraw their funds from the market, forfeiting any profits that the market's present conditions have previously erased. Stocks always see bigger returns after a down market and finish up stronger than before the bear market started. However, stocks, bonds, and mutual funds of a certain kind often do better during bear markets. Investors closely monitor the hiring, wage growth, inflation, and interest rate indicators to determine whether the economy is slowing down. Investors anticipate a short-term reduction in business earnings when they observe a contracting economy, so they sell equities, which causes the market to decline. A bear market may portend increased unemployment and difficult economic circumstances. How long does a bear market last? Before we go into that, let's hear a word from our sponsors. If you are like the rest of us, you must have looked at the skies at night and wondered, what's out there? Thankfully, through the Spacecoin project, you are one step away from finding out. Ever wondered what it may be like to go to space? Commercial space flight has been the subject of much hoopla in recent years. However, because of the lengthy wait times and exorbitant fees, it's still much beyond the means of the average individual. However, a decentralized group called the Spacecoin project is working to alter this. It seeks to make space travel a possibility for everyone. What is the Spacecoin project? The Spacecoin project is a cutting-edge commercial space venture created to let everyone take part in space travel in the future. Through decentralization and equitable pricing, it seeks to bring the general population to the thrilling experience of commercial spaceflight. The initiative aims to establish a reasonable and indexable market value for spaceflight. Therefore, thanks to the solution developed by the Spacecoin project, everyone may purchase tickets and enjoy the excitement of a space voyage. Users can exchange SPJ for a discount or even a complete space ticket as a part of the Spacecoin project procedure, depending on how much SPJ they currently own. Additionally, individuals who hold and stake a specific quantity of SPJ for a long time stand a chance to win a space ticket. Decentralization, according to SPJ's creators, is crucial to building a community of space lovers. As a result, the decentralized autonomous organization Space DAO was founded. Owners of the SPJ token have the option to take part in Space DAO decision-making. You have control over important issues as an SPJ holder, such as how many tokens are required for a space ticket. In addition, you can cast a vote on potential adjustments to the liquidation procedure. You may also cast a vote on the direction the community goes using the DAO. You may increase your token earnings over time by staking, which makes it even simpler to redeem the needed amount. The Spacecoin project could be the answer to your prayers if you've ever decided to travel to space. Click the link in the description and get an opportunity for space travel. That's all from this video. Are you a space lover? And what do you think about the Spacecoin project? Disclaimer, nothing in this video should be taken as investment advice. Because the crypto market is so unstable, conduct your due diligence and only invest money that you can afford to lose. And for more information on Spacecoin project, you can visit the project's website to see the white paper and the terms and conditions. Now, back to our bear markets. Generally, bear markets last 363 days on average, as opposed to 1,742 days for bull markets. According to statistics gathered by Invesco, they also tend to be statistically less severe, with average losses of 33% compared to a bull average market profits of 159%. The coronavirus bear market, which started on March 11, 2020, quickly transitioned into a bull market phase, while the full extent of the economic effects are still unknown. Equities normally take 6 to 18 months to recover their losses after a bear market. This might be a major issue, especially if you require assets during that time, such as if you're retired or intend to purchase a home. So what steps should one take to prepare for a bear market? Market declines are a reflection of systematic risk. This implies that rather than a particular company's weakness, stock prices frequently fall due to what's happening in the market as a whole. Investors frequently sell their holdings because they don't want to lose money, not because they no longer have faith in a specific company. Losses may suggest that investors have lost faith in the S&P 500, not the business model. Therefore, it's not always necessary to interpret losses as a sign that a certain firm has become weaker. Therefore, the first piece of advice in a bear market is to try to avoid selling, or at the very least, resist the urge to sell right away. If you sell during a bear market, you run the risk of taking unwarranted losses on stocks that have fallen despite the worth of the underlying business. That does not imply that you must trust everything also, just proceed as usual while analyzing risk. A bear market might highlight overpriced assets if you believe that a company's business strategy has become weaker or that it never actually had that worth to begin with. Simply base your decisions on the basics and don't sell unless you're very certain it's the proper course of action. Second, look for businesses that have high earnings per share. A bear market is a great opportunity to buy equities for great earnings. Investors will frequently sell good firms at low prices because they are selling based on systematic risk. Therefore, if you have the means to do so and the equities are strong, now is an excellent time to keep on to the stocks that you already own. But how can you discern the difference between an exposed poor firm and a good stock saddled with systemic risk? In actuality, there is no certain way to tell. However, it's often a good idea to check for something called EPS or profits per share. This gauges how profitable a business is in relation to its stock price. A high EPS implies that the firm is profitable relative to its share price, which frequently denotes an undervalued stock and a healthy company. These are frequently excellent bargains in a slow market. You can also put money into index funds. For many investors, the advice remains the same throughout a bad market. Consider investing in index funds. An S&P 500 index fund is often the best option for most investors. Since an index fund reflects a wide range of various companies and assets as opposed to growth, these often provide you with the ideal mix of diversification. In a down market, this is more true than ever. Individual equities might not bounce back from a bear market, but traditionally, the stock market, as always, does. As a result, investing in an index fund during a market downturn is a smart approach to get a historically reliable asset at a discount. Lastly, you can diversify your investments. Many investors view bear markets as a chance to make significant investments. This strategy, known as purchasing the dip, may be a very effective way to approach the market in general. Considering that Warren Buffett advised to buy when others are selling and sell when others are buying, it follows his recommendations. Just remember to use moderation. When a bear market has bottomed out and how long it will take for assets to regain their value are both unknown, you should avoid going all in at any particular moment. Rather, make gradual investments over time. You can buy more expensively during a bear market, but do it in segments. Put aside a certain sum of money one month, then another the next. In this approach, you may profit from a cheap market without taking unnecessary risks in any one direction at a time of uncertainty and volatility. Above all, practice patience, and remember that this will pass as well, frequently sooner than it appears. Many investors often feel dread when investing during a down market, but it may just mean being more assertive and patient with your choices. More often, it just entails adopting a somewhat more aggressive stance than normal while keeping your overall approach mostly unchanged. Working with a financial advisor during a bear market may bring peace of mind because many have previously weathered comparable market situations. That's all from this video. What other proven measures do you take to prepare for a bear market? Please share your thoughts with us in the comment section. See you in the next video.